So this question more or less, okay, how much has happened as a result of what happened in the past 2 years? The Dows have then doubled in the space of a year.
Okay,
And
I
has
got
that
this.
happened?
So how I would answer that. How I would answer that. The bond markets, I think, maybe put a number. It's like I think 80% of the damage is done. So that's why I said there's outstanding opportunities in the bond market, because could the yields go up? Let's say the Fed raises rates another 100 basis points. That doesn't mean bond yields are going to go up 100 basis points. They might go up a fraction of that. So the damage done for bonds being down 13%, a majority of the loss, I believe, is already in that. What I would also say, the majority risk right now is not inflation, which would further hurt bonds. The majority of risk out in the markets right now is a recession, and a recession is good for bonds. So in that aspect, that's a positive. On equities, what I would say, if you take a look back, let's go back to December 31st of last year, 2021. The markets were up, I think the S&P and Dow were both up over 20%. Over a 3-year period, they were up over 100%. That had only happened, I think, 4 times in the last 100 years. So were we due for some type of correction? Yes. Was it going to be this severe or this volatile? I don't know, but you could look back and you could say we were due for some type of correction that started actually in January and then accelerated when the man decided to invade Ukraine. But the scare, if you think about the first 6 months of the year, the scare was inflation, rising rates. The scare was inflation. The multiples in the market, in the equity markets, corrected. They went down from over 20 down over 21 or 22 down to where we are now, 16, 15. The market didn't correct because we thought we were going to a recession. We thought earnings were going to go down. So when they ask where are we, the markets are they down enough? I would say if earnings hold in, if the Fed's able to thread the needle and not send us into a profit recession, then we're probably down enough. I personally, and I do not believe, I think that risk is I think there's a greater risk that we don't thread the needle and we go into some type of profit slowdown, which means if we go into a mild recession and earnings fall 5 to 10%, that's probably the downside we're going to have from here, 5 or 10%. But if we go into something more substantial and earnings fall 20%, we have a risk of 20% in stocks. That's why I said in the beginning, there's vast opportunities in the bond markets.
Right.
Stock markets, you got to be a little more selective.
Right. If anybody is reading my newsletters, I've written about a cash cushion for retirees generating income for over a year. Right. So, and that's, we weren't getting paid for that cash for the longest time. And right. Now we're finally getting paid for some of it.
So I would say, some people, don't watch CNBC all the time. Hang in there. The markets usually are up 8 out of every 10 years. Maybe this might be one of those that we're down, but long-term investing, be disciplined are keys to financial success. And I think people that are listening to this call are doing the right thing right now. They're investigating what they should or should not do. And so keep invested and be diversified.
Absolutely. And as far as financial planning is concerned, there's a lot of opportunities to take advantage of down markets. Could be tax loss harvesting, Roth conversions. It could be, using, increasing your cash position, switching the investments to maybe increase the interest on your cash positions. I've seen a lot of that. I've seen people go from, getting 0.5 point to getting 2-3% on their cash. So
we just looked at one where they were getting paid under 30 basis points, and now they're getting paid 2%. So
is that right?
Cash position.
Yeah. Wow. That's like, what is that? Like 8 times?
And if you imagine it's a significant dollar amount, which some of these accounts were that. Yeah. So there are things out there that a normal, I won't say just a person out walking the street would not be aware. Oh, we can do this kind of stuff, which can actually add money and wealth to their without adding risk too.
No, 100%, 100%. And by the way, that's one of the metrics that you use when you're analyzing a portfolio, right? Is like what kind of risk you're taking and how much how much return you're getting for that level of risk as well.
Right. Risk adjusted returns are the key that we look at. So we won't look at it. Well, we look at it, but if a stock's up 50%, it probably has the potential to go down 50%, which is a 1-to-1 risk reward ratio. We like something that's 3-to-1, which means it has a chance to outperform, 3 times that of its downside. So that's something that's very, very dramatic, because if you're playing in the meme stocks, not only do you have to get the stock right, you have to get your timing right. And all those are very difficult, and I would say speculative decisions.